Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you trading levels and some popular company symbols for the upcoming week of July 1st, 2024. Before I begin, the usual disclaimer. Precision Trading Labs, we are not money managers nor financial advisors. Nothing here is to be construed as investment advice. Everything here is for informational and educational purposes only in order to help our subscribers to become competent, confident traders. So let's take a look at the charts here. I'll start out with Amazon here, and I'm actually looking at a 2-hour chart here. And so here's where we closed on Amazon at around 193 and change here. And so right up here, we notice price rallies up here. And then consolidates there, and then notice we have we have this series of red candles. That first one of which is a very bearish candle that comes out of there. This is an area right here at this area of consolidation. If we think of the shares that are acquired by willing buyers up here, we can think of that as demand for shares, and then we can think of the shares that are offered up by the sellers as the supply of shares. So within this region, supply and demand are in balance. Okay, as shares get kind of shuffled back and forth within this relatively narrow range. But right up here, we can see that there is a clear exhaustion of buyers here. No one was left or willing to buy up here anymore. Okay. And so, left in its wake, where supply and demand were in balance, once it goes out of balance and price leaves there, all you have left is supply, but there's no longer any demand left at this level. Consequently, we call this a supply zone. And so the foundation of our trades is when price returns to that supply zone, we anticipate that there is some residual selling pressure that's waiting to be tapped. And as a result, what we're expecting to do is to execute a bearish trade up here. And of course, the most basic way to express a bearish trade, of course, would be to short Amazon. An equally simple way would be, of course, to buy a put. And another way of expressing a bearish trade up here would be to, if you wanted to collect premium, you could of course sell a bear call vertical credit spread, and that would be a way of collecting premium. But in all three cases, what we would be doing is we would be anticipating another thump down from 197 three quarters somewhere within this range, and then that's where we would express again a bearish trade. And the way the trade, we can think of it in terms of how we would manage it and how we also gauge risk and reward is there's our entry. We would place our stop just a bit above the back line of this zone here, because that's where that structure, where we expect that supply and demand are, where we can gauge what's going on. Once price goes through here, we've kind of lost control of the trade, and essentially we're wrong. And so what we do is we give the trade the full depth of the zone. We give it a little extra wiggle room, and then if it goes beyond that, then we just admit that the trade's not working, and we take a paper cut. We take a small loss. Okay, so let's just say approximately that's where we would take our medicine and admit that we're wrong, and at that point, then we would get stopped out there. But if the trade's working, that would represent a 1-to-1 trade here. That's a 2-to-1 trade. That's a 3-to-1 trade, because the distance between each of these lines here represents that unit of risk right here. So once we gauge the depth of the zone, this allows us, in fact, then to generate our risk reward proposition, and then that also leads into talking about how we position size this as well. Okay. But anyway, that's where our supply zone is up here. So this supply zone is sitting at about a little over 2% distant from where we closed on Friday here at 193. So we would need about a $4.50 pop to get up to there, and then that's where we would short. And then down here, this is where we would anticipate going long from, having a bullish trade. And that's the same narrative of what I just talked about here, except of course in reverse. This right here, we have a consolidation down there, price pivots and then rockets out of there. So within here, supply and demand, again, we're in balance, and then it goes out of balance as right here as we have an exhaustion of sellers. Okay, and left in its wake, of course, then is only demand. Okay, and so in terms of expressing the trade out of here, this is where we would express a bullish trade. And again, we could of course buy Amazon stock at a little at 186 at 80 cents. One could buy a call, and of course, if one wanted to collect premium, one could execute a bear put vertical credit spread, and excuse me, a bull put vertical credit spread, and that's of course how one could collect premium out of here. All right, so that's the story with Amazon, and in fact, let me show you now what we in fact did earlier this week with our subscribers here. Right here, this was prior to this. Earlier this week, we had actually identified the supply zone here. Okay, and so on the 21st of June, right here, we had this rally base drop formation here. Notice price consolidated and dropped. Okay, so there was that exhaustion of buyers that I discussed just a minute ago. Okay, and so we were waiting for price to get up to that region in order to then execute a bearish trade in the three ways that I just mentioned a couple of minutes ago out of this supply zone here. Okay, and so if now we flash forward, okay, there was that level that I just showed you, and then price basically went up into here on the 24th. Our subscribers got into this by buying a put. Okay, so at 190.20. So right there was our entry point at 190.20. Okay, price came up in here, and then over a couple of days here, price came down here, and then this is where the the put dropped, rose in value from 1020 to about 1220. There was a nice 20% gain there. So excuse me, 20% gain, $2 on the put, and so the value of the put went up to 12 and a quarter, and then our subscribers sold out of that for a quick 20% pop on that. So that's the general principle of what a trade would look like out of one of these supply or demand zones there. Okay, so that's the story with Amazon. If we go back to the live charts here and take a look at Microsoft, so right here, here's where we're looking at now. We were actually looking at a daily chart here, so in fact, I'm going to go back to that. So right here, we have a rally rally formation here. Okay, and this is again a demand zone here. Okay, notice price, supply and demand were in balance, and again, price goes out of balance here. Okay, and so this is the exhaustion of sellers here. So okay, and again, we're waiting for price to pull back here. So that's a bit of a distance there. That's about 5.5% down. We had closed at around 446. So we would actually need about a 20 point drop on Microsoft to get to this area. But this is where the quality zone is sitting here. Right now, we're right there is kind of an all-time high and 52-week high there. So there's no supply up there in terms of executing a short. So we have nothing to push against there. So we're really just waiting for a pullback here, and then this is where we would get into this get into a bullish trade here. So that's about 5.5% down. If we turn over to Apple here, right here. Here, in fact, is there's a demand zone here on the 2-hour chart, right in here. So, in fact, if I switch this over to the 2-hour, you'll see right here that this is where the exhaustion of sellers occurs, which is right here. So right here, notice price rallies. Notice that spinning top there, and then notice price rockets out of there. So right here, we have this little area of consolidation, and then this very sudden exhaustion of sellers. Okay, so when price pulls back from the close here on Friday, that's about 3% down right there. Okay, and this is where we'd express a bullish trade out of here. Okay, and again, this is how we would structure it. Entry would be at 205.20. We would place our stop just a bit behind the back line of this demand zone. And so that's 1 unit of risk, 2 units of risk, 3 units of risk. So that would be a 1-to-1, a 2-to-1, or a 3-to-1 trade. Okay, and that's about 2.5%, 2.5% down. Right here is the high on Apple. But in fact, this is already tested supply, and so right now we're really just thinking of this as more of resistance rather than clean supply, because there's already been a significant amount of trading up here. So we don't necessarily know that there is any supply left here. We have an expression: the first test is best. Okay, and so right here, this is a fresh area of demand, and price has not been back there since. Okay, so as a result, whatever demand is there, it has not been tapped at all. Up here, where there may have been some demand, supply up here, it's now returned here, and so the price has been back here now once. So if we come back here again, this is what we would refer to as a retest, and a retest can work, but it's going to have a lower probability than the first test, which would be right off of here, because price has not been back here since this zone had formed here. All right, so that's the story with Apple. If we move on to NVIDIA, in fact, I actually have a slide to show you from last week. If we go back here, here's what we were looking at last week on NVIDIA on the 21st. Okay, so this is a daily chart here. Price rallied, consolidated. Then notice right there we had that exhaustion of sellers here. So again, we were waiting for price to pull back into this region, and then this where we would be getting into a bullish trade. Okay, so now if we go to the live chart here, and we actually go, here's the level that I was just showing you here. And let me go back to the daily here. Okay, so here's what I was just showing you on the daily. And so we can see um, on the 25th, price pulled into this region here, and then it bounced, and then it's kind of, it's definitely has bounced, so it's done half of its job, but it really hasn't sent this thing flying back up here. So what I would say here is that this demand zone again has done one half of its job. It has stopped price from falling, but it really hasn't sent it bouncing up yet. It's kind of gotten back up to about 1-to-1, but that's really as far as as far as it's gone here. Okay, so in terms of demand, we're actually a number of our subscribers are in this trade here. We're hoping that this week that this will obviously show some life and bounce from here. So at the moment, though, everyone's kind of just sitting tight with this. And what we did was we actually bought the option out, 2 or 3 months, so that we have sufficient time in the trades. We're not going to get too decimated by time decay. Okay, so we'll wait to see a few days if we, in fact, if we actually get the bounce that we're looking for here. So that's the story with NVIDIA. If we move on to Meta, okay, here's where we are on Meta, and in fact, here is the zone that we had, and the number of our subscribers are in this trade. And in fact, if I go back and show you, here is the supply zone that we had right here on the daily chart. So price rallied there, consolidated, okay, dropped out of there. Price returned here earlier this week on Thursday, and so now a bunch of our subscribers are on this. A lot of people, basically had bought a put out of here, and so that's the trade that we're in on Meta here. So we're out of this supply zone here, and then there's a demand zone that's sitting at around 5.5% below here. In terms of trade management, we obviously have this area to go in terms of accruing profit on this put. Okay, and then so that's the story with Meta, and we'll take a look at Netflix here. Okay, right here again, we have a drop base rally formation here. Let's stretch this out a little here. Okay, so right there, this is an area where again we have an area of demand here. Okay, right there, there's that sudden exhaustion of sellers that I described a couple of times here. So if price pulls back here about 4.5% down to around the 645 level, one could of course get into a bullish trade here. And of course, another way of getting into in addition to the buying a call, selling the vertical credit spread, as well as buying the stock. One way of doing this, because it's obviously a very expensive stock, would be not just to buy a call, but in fact to buy a call and then sell one that's further up. And that, of course, would be a vertical debit spread. And that would essentially lower the premium on the stock and essentially would also make it a gentler trade. So instead of, let's say, running a delta of 50 or 60, if you're buying it a bit in the money, by selling that other call, you of course would lower the delta, and so that would also make it a gentler trade. So a less responsive trade. So one could, of course, by doing the debit spread, but both lower the premium and also make it a essentially a gentler trade. And that obviously it suits certain traders that way. So that's the story with Netflix, and then we'll wrap up and take a look at our buddy Elon here. So at Tesla, so right here we have our drop-based rally formation. Right there was an exhaustion of sellers here. So right there, this is where we would express a bullish trade here. And then right here, we actually ran into a supply zone here. But because it was Friday here, and it actually happened relatively late in the day, I think, we didn't really get into this trade. But this is clearly a rally-based drop formation. Notice there's that very bearish candle here. So this is in fact where we would expect that price would have dropped, and of course we can see right there, it did kind of dig its way into that zone, and then by the end of the day it had started to drop out. So we'll wait to see what this chart looks like Monday morning, and then in fact that might be a place that we might again express a bearish trade if it's showing signs that it's going to continue to drop. And at that point, then what we would do is we would set our target somewhere around, basically at this demand zone, which is of course what would oppose the trade once it got down there. Okay, so if we actually got into the trade, let's say right here at around 198, in fact, then the trade would look more like this. We would actually have to, of course, pull this down till it's about 198, which is around there. And then we can see where our risk reward would be. So this actually would not be probably the greatest trade in the world, because probably would not expect to see more than, let's say, 1.5 to 1 on this. And generally when we build a trade, we more or less want to see that we have the potential to get at least 2.5 or 3 to 1. Or really a minimum of 2 to 1 at any rate. So the fact that we really wouldn't necessarily even expect to get 2 to 1, this would actually kind of represent kind of a mediocre trade. So in fact, now that the bus has left the station, it's actually not really that great a setup anymore. But we'll take a look at this on Monday, and we'll see where that stands. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and we'll see you next time. Take care.